everyone. Very good evening. It's 5 p.m. on the clock, which means it's time for our Rise with India Primetime segment. And as always, we kickstart this very special segment with the Money Show, which will be chatter all about your pocket, your wallet, and your finances. Well, it's just the second last day of the new year, or rather the old year, and we're going to be welcoming in the new year. And hence, I think it's an important time. Use this end of the year as an excuse to review your investments, to give your portfolio an annual review, which all of you must do. Yes, we invest for the long term, but reviewing your portfolio is something that's extremely important. On today's show, we'll be discussing which are the duds and which are the hits and how to judge them in your portfolio. Also, while we'll be talking about mutual funds, we'll also be talking about insurance, because the year gone by has certainly been a very eventful one, with the IRDAI coming out full throttle to simplify schemes to make them more transparent for you, the customers. So we will be joined by Naval Goyal of Policy X. And later on the show, in our Spend with TMS segment, credit cards are our go-to plastic money for all spending items. And why not? The kind of points they give and the rewards that they offer certainly are very, very lucrative in the long term. So I will be joined by Anshuman Mishra of Loan Adda to discuss the same. But before we do any of that and kickstart our exciting episode of The Money Show, here's a quick look at the headlines. No year-end fireworks on the Lal Street. The early gains fizzle out too, with the Nifty slipping below 12,250. PSU banking lot causing pain, but auto stocks take the driver's seat. It's an ET Now impact. The stock price of BPCL recovers from the day's low after ET Now reports that the government is hoping to sell its stake in the company at a 30% premium. Sources say the government is eyeing a total valuation of 1.4 lakh crore rupees, and an expression of interest should be out by mid-Jan. Home loans set to get cheaper in the new year. State Bank of India reduces its external benchmark rate by 25 basis points. The new rates are applicable from the 1st of Jan 2020. The HFL Creditors Committee, or the COC, is to hold its first meeting under the Insolvency and Bankruptcy Code, the IBC. Sources say discussions will revolve around the resolution process and the timeline it will follow. The RP, or the resolution professional, will also appoint valuers for the assets and loans of DHFL. General Bipin Rawat is named India's first Chief of Defence Staff. The development comes just a day before he was set to retire as the Chief of Army Staff. The age limit of the post of CDS is 65 years. North India continues to reel under intense cold as dense fog affects the movement of flights and trains at several places. There is near zero visibility in the Delhi NCR region, with a low of 2.6 degrees Celsius. Delhi is colder than Shimla today. Maharashtra Chief Minister Uday Dhoot expands his cabinet, gives son Aditya Thackeray a ministerial berth. Congress top gun Prithvi Raj left out. NCP's Ajit Pawar returns as the Deputy Chief Minister once again. Well, those were the headlines we'll be tracking for you all evening on ET Now. But on the Money Show, we are going to be talking about an annual portfolio review. We're just at the fag end of 2019, and hence it's the best time of the year to give your finances a re-look, to check as to what your portfolio has done, which are the outperformers, which are the underperformers, and how exactly should you judge the same. But I'm sure many of you guys may be wondering that if we talk about mutual funds being a long-term wealth creator or a long-term wealth creation tool, then why even bother reviewing? Well, that's what we will understand with Uday Dhoot. He's the co-founder of Venn Wealth. Uday, thank you so much for joining us on the Money Show. doctors, dentists, they often recommend that you get a physical checkup and, a checkup done about once a year or so. And I suppose financial advisors as well recommend that you get a portfolio checkup done once a year, sitting down with your advisor, checking if everything is still on track. So, Uday, why would you recommend that our viewers do this annual portfolio review when on one hand we do say that, hey, mutual funds are to be used only for long term, that's 5, 7, 10-year goals and 10-year time horizons?
Um, um, I think it's important that an annual review is conducted, and there are various reasons why one needs to conduct an annual review. And if I were to just think about it, let's just break them down into two different reasons. One set of reasons, it initiates or permeates, it basically starts from the individual or the family which runs that portfolio, and so that they are internal to that family or to the individual. And then there are another set of reasons which are external to the family or individual. So let's first talk about the internal reasons. When anyone creates a portfolio, he has a particular thought process, a particular set of goals, a particular set of income expenses, and based on that he has designed saying that, hey, this is what I need, this is how I need it. And that's how the asset allocation is decided, that's how the divide between equity and debt is decided, and fixed income, and so on and so forth. So you get an allocation based on your goals, based on your requirements, based on how your mental profile is made up in terms of how you've been in investments, how much experience do you have in terms of investments, what are current assets, liquidity requirements. Now what happens is that over a year, many of these things could go through a change. What could go through a change is that your goals could go through a change, your income, your expenses go through a change. There could be sudden a big income that you said you're working in a startup, the startup got funding, some of your shares got bought up, your ESOPs got sold, and you got a bump of money, and you want to relook at your financials accordingly. Or suddenly some large expenses came up and which sort of trail you off the plan that you had planned at the beginning. So irrespective of what are those income, expenses, or professional or personal changes that have happened, see how do they impact the overall requirement of how you should be saving money, what you should be doing with that money. And that's the internal set of changes that sort of comes about, and why you need to do a review. Sometimes these things can wait for an annual review, sometimes they are large enough that they need to be reviewed at then and there itself. But let's just say that these things do impact your sort of regular portfolio requirement. Now apart from the internal requirements, internal changes that are happening to the family or the individual, the external environment is constantly churning, making changes, and to that extent what you thought was the best thing to do maybe 12 months earlier may not be the best thing to do whenever your review is due. So what are such things, and let me sort of elaborate of how these changes can take place. Now let's say if you were investing in 2016, 17, 18, 19, or let's say 2017 beginning, and if you had invested in say small cap funds, by the end of 2017 small cap funds had done phenomenally well. Now there are no changes at your end, but that category has done exceedingly well, and maybe the risk in the category has gone up, the return profile has sort of gone down, and you may want to now make some changes to your portfolio. So nothing changes at your end, your goals remain the same long term, so on and so forth, but because there is such sudden outperformance, you would like to relook at certain things. Some things that you considered very safe could basically become risky. Let me give another example. So let's say the whole category of say PSU, banking, corporate funds, which have, if you are invested in them last 1 year, you've made phenomenal returns, right? You've done exceedingly well. Now they may not be risky from a credit standpoint of view, but going forward, are they the best places for you to hold your money? So the risk return profile of the investments can keep changing because the external environment keeps pricing things differently at different points in time, and that's why you need to make changes to your portfolio. Apart from that, certain things which were considered very liquid can suddenly become illiquid. Let me give you another example. Let's say real estate, which probably say 4-5 years back was relatively liquid, but over the last 3-4 years, because of this downtrend in the market, has become extremely illiquid. So suddenly the characteristics of the underlying investments that you hold could change, and that would require you to sort of relook at things. Essentially all of this builds up and changes your asset allocation. Now the asset allocation can also change without you making any changes to the portfolio. So let's say you started the beginning of the year with a 50% equity allocation, 50% fixed income allocation. Now if suddenly, let's say the markets have done, equity markets have not done well, and the equity portfolio is down 20%, so essentially your 50 rupees became 40 rupees, but your 50 on the other hand grew to say 55, so suddenly your 50-50 allocation has become 55-45. So you need to rebalance your portfolio because your asset allocation has changed from what you are thinking as a long-term asset allocation. So now these are the reasons, both internal and external, why a regular review, whether it's an annual review based on calendar or based on some other anniversary date that you come up with, you need to look at things, make those changes to your portfolio so that it is in tune with both your internal and the external environment.
Okay. Well, it's quite a comprehensive, set of reasons that Uday has listed out. Now, I want to talk about individual categories, Uday, you join us on the Money Show so often. You must have noticed this one query that we get from a lot of our viewers, that, oh, I invested in XYZ small cap or XYZ mid cap fund 2 years ago, and it's -2% and it's -3%. What should I do? So that brings us to the question: what should you do then with the underperformers? What should you do with the loss-making units that you own in your portfolio? You briefly alluded to it in your previous answer, but yeah, I mean, when you look back now and you believe, oh, this fund didn't work for me or that fund didn't work for me, would you advise that then investors should completely exit, or they should look at it from a more holistic perspective?
So basically, I think the way to think about this is that when should one think about exiting a particular investment or fund? And I think that's a really hard one to answer, and it requires some amount of discipline to think through of how one sort of thinks about it, right? Now let's just think about some of the simpler things that one could do before one comes to this question. Is that when you are building a portfolio, don't go by pure, and we keep talking about this on the show, is that don't go just by the top performers of last year. Build a diversified portfolio. I think we have given multiple times an analogy where saying that, hey, if you are going to be playing a team, and assume your portfolio is like a team, you need different types of players. You need like a Rohit Sharma, you need a Virat Kohli, you need another stable guy out there. So you need like a team, and you very well know that all of them are not going to perform on a single day. There will be times when a certain category performs, there will be times when another category performs, and it is very, very hard to say this sitting here as to what will be the outperformer or the best performer in the next 1 year or 2 years. It is just not possible. So it is important to hold a diversified portfolio. Ideally for first time investors, stay with diversified funds. Don't go to pure mid caps or sectoral funds as such. Hold diversified funds. So that's what you could do before you have made your portfolio. Now, assumingly you have made an investment choice, and now you want to think that, hey, there are underperformers, and what should I be doing? Now, there are few things that one needs to are clearly signs of things that you should be watching out for, and those are sudden changes in the mandate or the investment style. So let's say you invested in a fund because of the way it was managing the money, and after 3 months or 6 months the fund manager changes the style or says that, no, this is not how this fund is going to be, this is how we are making the changes in the portfolio, which is not what it was when you actually invested. And why you invested? Because you looked at the performance and that style, and that's not the style that you're getting. So basically a change in style or mandate definitely is time when you should be thinking about exiting the fund. Second, if there are changes in the important people who run the fund, so whether the fund manager, if there are changes around there, something that at least should give you a pause, something that should make you think about saying that whether I should make a decision or no here. The other thing that maybe people could do is to track the inflows and the AUM of the specific scheme or the fund that you're invested in. And if it is going down or going up very, very quickly, maybe these are warning signs for you to sort of start reacting. Now, I have sort of left away one point, which is the underperformance. Now, this underperformance is a very hard one to take a decision on, and I'm saying this hard because like I just said, I'm saying just because somebody didn't do well for 2 games does not mean he's a bad player. It's just that maybe he's having an off time, right? So it's a hard one to take a call. But let's just say if over a couple of years your fund is consistently underperforming the peer and the benchmark, then you need to definitely take a hard call and move out of that fund.
Okay. Well, it's a tough decision, but it will have to be done. And even though your NAV may be down, sometimes it's important to recognize which exactly are the duds and which could still turn out to be the shining stars. And you just need a little bit of patience when you are dealing, with those individual units. So, Uday, as we kickstart 2020, and let's assume that a lot of our viewers may have just gotten a job, they've just graduated, and they want to kickstart, their financial journey now. They want to save for retirement. What are the golden rules you would recommend they work with when creating a portfolio?
I think the golden rule is very, very simple. And the first rule is put aside some money at the beginning of the month. Nothing is going to work if you're not going to make it happen. So the first thing I would recommend pretty much everyone is that start saving at the beginning of the month. Like we say, the golden rule is first save, then spend, right? So you start there. The second thing that today a lot of youngsters should realize is that they have very easy access to credit. Which means that there are many times they will outspend what their actual affordability is. Now, one needs to be very, very clear that the usage of credit needs to be disciplined. You should know when you want to use credit, when you don't want to use credit, what credit is good for you, what credit is not good for you. Just because credit is available, it does not mean that you need to take it, right? So I think the usage of credit is something that they need to think about. Third, I think for youngsters is that initially try investing in different types of investments. A lot of times I've seen youngsters will just go buy, say maybe what their uncle or parents or somebody at home said, that just buy an LIC or do a post office or do this. I would say you're young right now, you have some savings. Maybe take some of these savings and try equities, try mutual funds, try different things, so that by the time you grow in your career and you have built some experience, you have also built experience in investing in different types of investments, and you sort of gathered that knowledge to sort of plan yourself better when your earnings and savings improve and increase, and you know that, hey, these are things I want to do, these are things that run best with my profile, these are things that don't run best with my profile, and maybe those are things you should do. So invest some time with your financial decisions. If it is not important to you, it won't be important to anyone else. So those are things that I would tell youngsters: first save and think about credit, try out few things. All these things are maybe critical for them.
Okay, well, folks, I hope that among your various New Year resolutions, financial planning is as well one resolution. Usually all our resolutions have got to do with diet, food, among other things. But you know what, at this juncture, I'd like to invite all our viewers as well to ask any questions that they may be having. This is your opportunity, folks. I'm sure many of you guys may be having a mutual fund portfolio. If not, what are you waiting for? And if you still don't know where to start off with, you can still call in 24990300, and Uday Dhoot will be here to answer all your questions and queries, and of course help you with your year-end review as well of your portfolio. Okay, so for now, let's kickstart our Ask the Money Show segment. We have Ritesh Agarwal, who has sent in a query via email. He says, I'm 37 years old and have been investing in SIPs for the last 1 year. The following are his funds. There's the Mirae Asset Emerging Fund, 25,000 rupees. The Canara Robeco Emerging Equities, 30,000 rupees. The L&T Mid Cap, 30,000. SBI Small Cap, 15,000. He has two main goals. One is for his retirement, and the second one is for his son's education. So it's a nice meaty chunk that he's putting in via SIPs. He wants to know if he must continue with these funds or switch to a new fund. Now again, he started these SIPs only since the last 1 year, so it's still very early. Nevertheless, Uday, what do you make of these funds in his portfolio? Do you think he should add some more? Do you think he should perhaps cut down the amount he's putting in one of these funds? What's your recommendation?
So a few things about the portfolio as you see it is that it's a 100% equity portfolio. Within equities, it is completely focused towards mid and small cap funds. That's the other thing that you see about the portfolios. So Ritesh, few things that you have to realize is that, as you have said, these are long-term goals. Equity is a non-linear product. You don't get returns on a regular basis. You will get bumpy returns, and the only thing that has happened for you is that apart from being predominantly in being 100% in equity, you are also towards the slightly higher end of risk curve on the equity as well, wherein mid and small cap funds. I would say that maybe you should reconsider that strategy and sort of balance out your portfolio a little bit. Maybe add some multi cap funds and maybe some international or index funds. So those are things that you should be thinking about from a portfolio change perspective. One of the funds that you're investing in, L&T Mid Cap Fund, has recently had their CIO, the fund manager, sort of quit, and there are changes. So that is something that you would like to review. I won't say that it is bad just because the fund manager is gone, but for adding fresh money is something that you need to think about and review as well. So maybe these are a few things that you should be looking at your portfolio. Equities are for the long term. You've just been doing this for 1 year, so look at it at least for 3-5 years minimum before you start looking at the performance as such.
Okay, so those are the chops and changes recommended by Uday Dhoot. We've already got one of our viewers joining us right now on the phone line, Ram Kumar from Tamil Nadu. Mr. Kumar, thank you for joining in. What's your query?
Hello, Mubina. This is Ram Kumar from Tamil Nadu.
Yes,
Happy New
namaste,
Year
sir.
for you and your guest.
Yes, sir. Go ahead. आपका क्या question है?
Yeah, I just want to invest 15,000 in a mutual funds.
Okay.
So I need a small cap, mid cap, and large cap mutual fund suggestion.
You don't have any other mutual funds in your portfolio?
Right.
Okay, I think I'm going to take the voice. I think cracked a little, but I think he said no. He does not have any mutual funds. So yeah, he's a novice. He's just starting off. How would you recommend he, start off his, portfolio building journey?
So maybe we could have asked him a few more questions if you have ever experienced investing in equities before, if not to mutual funds, to other resources. But importantly, Mr. Ram Kumar, please realize that equities is
okay.
Good for
You know
the
what,
long term.
Uday?
So
in fact, I think we do have our viewer with us right now on the phone line. So, Uday, you could go ahead and ask some counter questions to Mr. Ram Kumar so that you'll be able to help him out.
Mr. Ramkumar, just wanted to check, have you invested in equities before, and what are your specific goals, if at all, and anything else that you've experienced from an investing side point so that we know what you're exactly looking for and recommend you accordingly?
Mr. Ram Kumar, Mr. Uday Dhoot actually had a question for you. If you could reply to him. Okay, no. Unfortunately, we've lost Mr. Ram Kumar. So, you know what, Mr. Dhoot, continue with your answer then. Unfortunately, we'll not be able to. But yeah, just a recommendation for all our viewers as well. When you do put in a question, just ensure you try and, share a bit more of your profile for the benefit of the financial advisor. Go ahead, Mr. Dhoot.
So basically, Mr. Ram, a few things to always think about when you're investing is that ensure that you have managed some amount of emergency funds for yourself, so that whatever long-term investing you are making, it is not disrupted by a short-term requirement. So you have some emergency fund. Take care of risk before you sort of start investing. So ensure you have appropriate amount of health insurance, life insurance, term insurance, whatever you need based on your requirements. From an investing standpoint of your long term, if you're not invested in equities before, what I would recommend you is that maybe from a large cap standpoint, do index funds, the Nifty index or the Nifty next 50. Those index funds is what you could sort of invest in. So let's say in Nifty you go say around 5,000 you could possibly do in a, because you said you wanted a spread of large multi and sort of small cap, maybe you can do 5,000 in a multi cap fund, and it could be like say a Parag Parekh long term value fund, and then say another 5,000 in a small cap kind of a fund, which could be say an Edelweiss small cap fund. So this is how you could basically break your investments into 3 different funds. But again, if you had more clarity, maybe we could have given you a better answer, but that's what I could think of right now.
Okay, all right. So I hope, Mr. Ram Kumar, you've heard out Uday Dhoot's recommendation. Okay, next up we have Navpreet, who's joining us on the phone line from Chandigarh. Navpreet, hi, good evening. Thank you for calling in. What's your question?
Hello.
Yes, Navpreet. Hi, what's your question?
Yeah, ma'am. Good evening.
Good evening.
Yeah, my question is regarding a few of the funds I have. The three of them are not at the. Yeah.
Yeah, go ahead. What?
Hello.
Yes, go ahead,
Yeah.
Navpreet.
The query is that I've got ICICI Prudential Value Discovery Fund,
Okay.
HDFC Mid Cap Opportunities, as well as the ICICI Prudential Focused Fund. All
Okay.
these are not performing lately, although I am holding these funds for more than 7 years now. By way of SIP, I am investing in these funds. But lately, all these three funds are not showing good signs. So should I switch over to some good funds, or should I continue with them? Just I wanted to
Okay, so you
have
have
advice regarding these funds.
okay, you have a whole portfolio, but you're just concerned in particular about the performance of these three funds, and you've been investing.
Yeah, exactly.
Okay, got it. All right. So again, Mr. Dhoot, the point we were discussing earlier, right? I mean, how should you identify if a particular fund is a dud and it's time to exit? Mr. Navpreet has been investing for 7 years, so that's a decent time horizon. What would you recommend?
So I think on the value discovery, the larger value category has not done well over the course of last few years. Growth companies have done far better, and growth and that part of the index or that part of the overall market has done far better than the value companies. And we have seen this happen time and again with the value category, wherein they go through these cycles of underperformance and outperformance. So if this is one part of your portfolio, I would say you hold on to it. If this is all that you have in your portfolio, then definitely diversify to another category. But if it's just one part of your portfolio, the fund manager has done well in the past, is going through a lean patch, or maybe the whole category itself is not doing so well, so I would expect some recovery there in the value discovery fund. In the HDFC mid cap fund, I think the fund has actually done well, as the category did well. Over a period of time, its size has grown up quite a bit, and generally in the last 1.5-2 years, the mid cap small cap category itself has not done so well. So to that extent, there is that underperformance which is there. So I would recommend that maybe you hold on to that fund. But if this is the only fund that you have in the mid cap category, then maybe diversify away. Given that you've been doing this for 5 years, maybe put aside some of the money in some another fund, mid cap or a small cap fund. The last fund that he spoke about was which one? I'm sorry, I couldn't catch that.
Okay, I think it was there was the ICICI Prudential, ICICI Focused, and I'm not sure which fund was. Do we still have Navpreet with us? Navpreet,
yes, ma'am, it was the Yes, ma'am, it was the ICICI Prudential Focused Fund, which is the
Focused.
large cap.
Okay, yeah, it was the Focused Fund. Uday?
So the focus fund, actually again I'm sort of trying to answer these things one-on-one, and these are very difficult things to answer one-on-one, Manpreet. So what I would recommend to use that, again, the focus fund is a large cap fund with few select set of companies. Again, within the large cap category, what has happened, one needs to remember, is that I think almost the whole category has struggled to beat the index. The index itself has done far better than the category. So there definitely there is a need, at least in the large cap segment, to move towards index funds for most of us, to cut down on the cost as such. But I think for us to better judge how and what you should be doing on your portfolio would be to see the whole portfolio and then tell you what is right, what is wrong. Taking calls on individual products will not work for any of us. It does not work, because then it sort of lopsides your portfolio towards recent outperformers and takes away all the recent underperformers, which sort of builds that whole thing for future sort of underperformance. So I would say that I would tolerate some amount of underperformance in my portfolio, because that's how different categories of funds behave at different points in time.
You know what, Navpreet, you can always connect with us on the Money Show at etnow.tv, giving us the entire list of all the funds that you hold in your portfolio. And, that would give Uday Dhoot as well a better idea of what exactly are the constituents of your portfolio. So I'd request you to do that. In the meanwhile, I'll move on to our next caller. Sunil is calling us from Chennai. Hi, Sunil. Good evening. What's your query?
Hi. Hi, this is Sunil.
Hi, Sunil.
Just need to check, is it good to invest in mutual fund by withdrawing money from PPF for long term?
Okay, you want to withdraw your money from the EPF and you want to put it in the market. That's basically in mutual funds, and you don't have any other mutual fund, I would assume. So yes, again, a novice in the mutual fund world, he wants to withdraw his corpus from EPF, which is not a bad idea, especially if you're a long-term investor. And EPF will obviously give you a limited return or an interest amount, whereas a mutual fund still has more return potential if you are a long-term investor. So yes, Uday, what would you recommend he start off with?
Sorry, you said this money is currently in PPF or EPF? What did Mr. Sunil?
He mentioned EPF, Uday.
Okay, EPF, that is the Employee Provident
Yes.
Fund. Okay, now, so very important, Mr. Sunil, that you realize that the nature and the characteristics of EPF and PPF type of investments is that these are basically pretty much government guaranteed investments where you get a fixed return almost linearly, sort of like an 8% year on year, no risk, no downside. You don't need to look up your portfolio value, you don't need to worry about news headlines, economy, etc. You get that 7.5-8% year on year return. Now, as soon as you move from that category to mutual funds, irrespective of what type of mutual funds you choose, whether these are debt mutual funds or equity mutual funds, they are governed by regular NAVs, which means that the performance will change on a month-on-month basis and so on and so forth. And to that extent, the behaviors will be very, very different. So I don't want to make these comparisons between, say, an EPF and a mutual fund, because they are by nature very, very different investments. But if now, say, if you have to withdraw the money out of EPF and you think that maybe I would be able to make more money into in mutual funds, then I would say that you have to basically take in some amount of equity exposure there for your portfolio. And maybe if you have 100 rupees today, start with, say, around a 25% sort of an equity exposure, 75% fixed income within the debt mutual fund kind of an exposure. See how that sort of behaves. This is in the absence of not knowing exactly your profile and your other investments. See how that behaves over the course of next 1 year, 2 years. See if you are able to stomach that movement and those changes in the way in how the returns sort of shape up. And as you sort of become comfortable with different investments, with knowing these NAVs, etc., understanding these things better, then maybe start allocating it more towards a slightly higher equity allocation. But again, it depends on what your overall requirement and time frame is.
Sure. Okay, all right. But with that, we are out of time, so we'll not be able to take any more queries. Thank you, Uday, for joining in and very patiently answering all those questions and queries. We'll take a very short break right here on the show. But when we return, we are going to be talking not just about mutual funds, but insurance. Because while it's important to earn money, it's also important to protect your assets, the most important one being your life. So stay tuned for that.